Hello, everyone. Dave Landry here. I'm really excited to do my first show here at StockCharts.com. So, what are we going to talk about? Well, first, I have quite a few people to thank, and I'm going to get through that real quickly. I was thinking earlier, if I told the whole story of how I came to StockCharts.com to have a show, we wouldn't have a show today. I want to go over some of the ground rules that I believe in very firmly. And I say some here because there's quite a few, and we'll go through those in future shows. I want to touch upon real briefly what's more important, mine, in other words, trading psychology, money management, or the methodology. And I want to spend a little bit of time on a trader's journey. Now, I know what you're probably most interested in this week relates to the methodology. So I want to get into trend and a simple way to determine trend and a simple way to use an indicator to determine trend too. And finally, does this stuff really work? Can something simple actually work in real markets? Now, before we get into all that, obviously there's quite a few people to thank. And again, the story is kind of a long one. So first of all, I want to thank Greg Morris, Chip Anderson, the fearless leader over there at StockCharts.com, Mary Ellen McGonigal, and of course, the producer, Rachel Ackley, and the chief of technology, Zach Dillon. There's a disclaimer screen. As you know, you can lose money trading. I often sum it up, borrowing a line from my good friend Greg Morris. All predictions are about the future, and a lot of stuff can happen between now and then. Now, here are some of my ground rules. First and foremost, it's not my way or the highway. This is just simply the best thing that I've found after many years of grail hunting. And we're going to get into a little bit of grail hunting in just a few minutes. It's conceptually correct. It's a methodology based on the psychology of the market's participants. In the mid-90s, I worked a little bit with Larry Connors doing some consulting and research. And every now and then I'd fat finger a programming system or something that we were working on, or I was working on. And the results would be positive, but we couldn't figure out why it worked. So we tossed it out. So conceptually correct as a concept is a term that I borrowed from Larry Connors. And also I like to kind of see it as Dave a la carte. I've had the privilege of working with some very intelligent people over the years. And I just think that, well, my stuff is so simple, they would never use it. And quite a few of them had said, no, this concept that you use, for instance, like with your money management, that makes a lot of sense and I never thought about it. So it's kind of surprising to me and quite rewarding that people can take little pieces of my stuff to make their stuff better. Now, first of all, I'm not holier than thou, and nor do I claim to be the grand poobah. I drop F-bombs. Today's been a good day so far, but yesterday was kind of a ugly day, at least on the start, and I dropped a few F-bombs, and I'm human, and I don't claim to be the be-all, know-all. Now, everybody's all excited about methodology, and everybody wants the greatest setups. Everybody's a bit of a setup junkie, and the money management in the mind tends to come down the road. In reality, that script should probably be flipped to where if you get your attitude right, then those other things fall into place. And money management is vitally important. And then methodology is, I wouldn't say mechanical because I am a discretionary trader, but there is a lot of mechanics that are fairly easy to learn. And the money management is almost mechanical in quite a few ways. So attitude is much more important than aptitude. And as you'll see in a little bit in this show, but specifically in future shows, we're going to do some deep dives into the trading psychology, which is vitally important. Now, if you think about trading with technical analysis, basically you're reading the emotions of the market while at the same time embracing your own. Now, I chose the word embracing specifically because you cannot eliminate emotions. If you were emotionless, you'd be dead in the day. And there's actually neurology that proves that. And we'll get into that much further down the road. Now, I like to approach trading holistically, combining money management, methodology, and mind. And I like to see it as a three-stranded cord. And the great thing is, if you get better at any one of these, you get better at all three. Now, earlier in the slides, I said, what's more important, mind methodology or money management? Well, they're all three important. Let's say you have the best methodology in the world. If you don't have the proper mindset to follow it, then it's worthless. And also, if you don't have proper money management, then you're liable to blow up even with a fantastic methodology. So all three are vitally important. And again, if you get better at one, you get better at all. Now, we all seem to go through a trader's journey, and some of us can get through it in a year or two, and others it takes many years, and sometimes we just get stuck and we never make it full circle. We tend to all start with a blank chart, or pretty much a blank chart. This chart's at StockCharts.com. I have mine set to blank chart and then a few moving averages or another one, but I think the chart for the most part, when you first get started, might have one moving average and that's about it. Then we all tend to start adding indicators and then more indicators and more indicators and more indicators. And this is where confusion begins to set in. And if we're not careful, we can go off on a serious tangent and end up in the rabbit hole of studying the complex and the arcane, system surfing, and guru seeking. And guru seeking is a dangerous road to go down. And you're probably thinking, but Dave, aren't you a guru? No, I don't see myself as a guru. I just see someone who approaches the markets again in a conceptually correct fashion, using a little bit of common sense. Hence the name of the show, Trading Simplified. If it were that easy, as some of these guys say, make 2 to 4% a day. I did the math on that. If you could make 2 to 4% a day, you would have about $200 million at the end of the year, starting with just about $10,000. And as I was talking with the production crew earlier, if I could do that, you'd never see my fat butt again. So this is kind of where you end up on that holy grail hunt, thinking that there has to be some sort of secret to the market. And a true enlightenment comes when you realize that there is no secret and you begin to remove indicators. And then that's when the understanding begins and you'll find yourself back at a blank chart. Now, I truly believe in keeping things simple. If you can't explain a trading system on a cocktail napkin, then toss it out. And I tossed out some cocktail napkins at the last speech that I gave over in San Francisco. And this is my entire methodology pretty much in a nutshell. For the most part, I'm trading pullbacks and I'm looking to take a swing trade off. That IPT stands for the initial profit target. I have a stop in place just in case I'm wrong. And then I trail a stop higher, hopefully, to stay with the trend for a long, long time. John Bollinger used to have a forum in Professional Traders Forum. He was kind enough to invite me. And he would always end his posts with this byline: if you advance far enough, you arrive at the beginning. And I just love that. And one day I called up John. I'm like, John, what's the genesis of this? And he said, well, he watched a documentary on Albert Eiler, and it said that he had advanced so far in his music that he came back in the beginning. And John went on to say that it's probably the original thought comes from T.S. Eliot, Four Quartets: we shall not cease from exploration, and the end of all of exploring will be to arrive where we started and know this place for the first time. So me getting back to the blank chart, and many people who I've worked with over the years getting back to the blank chart, that's where the true enlightenment happens. And I've had quite a few people start with me, go off to chase rainbows, and 10 years later say, Dave, I get it now. This simple stuff, trends, pullbacks, simple money management, you're not going to print money and make 2 to 4% every day, but longer term, I could see where that works quite well, as opposed to all this system surfing and grail hunting. Now, one thing that you have to think about, and I think about this every day, in order to profit from a trade, any trade, you have to capture a price move. And that's all you have to do. My wife is always goats me with like, in order to fix something, she's like, well, all you have to do is just with your wrench. And, so I get in there and I wrench the pipe, and next thing you know, the pipe's burst, and I'm to the hardware store or whatever and calling a plumber and God knows what else, losing my religion. But if you boil it all down, all you have to do to make money on a trade is to capture a price movement. And that's why I focus on price and only price through simplified technical analysis. So again, the only way to profit from a trade or any trade, on any trade that is to capture a trend. You obviously have to sell higher than you buy. Now, I didn't say buy low and sell high because that could be a bit of a loser's game. If the market is dropping, as I often joke, it's always darkest right before it gets more dark. You do not want to catch that falling knife. You would focus on capturing a trend by trading with the trend. Now, technical analysis 101 states that if a market is at A and C is above A, let's say A is $10 and C is $30, it's going to have to pass through B, assuming, let's say, B is $20, just for example purposes, along the way. Now, there's no other hard and fast concrete type of rule in any other type of methodology. You can't say buy a stock because the PE is this or something along those lines. But with technical analysis, if you get back to the basics, technical analysis 101, if a market's going to go from A to C and B is in between, it's going to have to pass through B, obviously, along the way. Now, you can't just always buy at B, although I do have an IPO strategy that does pretty much that with a few caveats, and it works quite well. And we'll show you some of those setups over time. Be happy to show you those setups. But you'd be much better off buying at B or trying to buy at B than fighting trends. And I've helped a couple of college students and a high school student, well, my daughter in particular, for the high school students, do really well in stock picking contests simply by focusing on getting long around that B level. Now, there's only 3 states in which a market can exist. It's either an uptrend, which is demand, a downtrend, which obviously is supply, or it can go sideways. People often forget about the sideways movement. And since sideways is where your equilibrium, you have equilibrium where demand is equal supply. So you always have to truthfully ask yourself, which is it? And it may not be what you want it to be, but what is. Unless, of course, you're Bill Clinton. Linda Rasky once said, if you don't know what the trend is, ask a 6-year-old kid. I've quoted Linda so many times on this, people started quoting me as saying, and I'm like, no, that's Linda. And in fact, I haven't said it as much as I used to because I want to make sure she gets credit for that. But that makes a lot of sense. The 6-year-old doesn't have any emotions tied up in the charts, and he's not thinking that this trade could pay off a credit card or whatever the case may be. He's just looking at the charts and say, well, it's going up, it's going down, or it's going sideways. Now, I know all this is a little Captain Obvious, but you'd be shocked at how many people fight trends. And more importantly, how many people deal in mediocrity. People will send me charts all the time that look like an electrocardiogram and they want to buy the stock. And I'm thinking to myself, all my preaching about uptrends, downtrends, sideways, why would they want to buy this stock? Well, the answer did come to me later, much later down the road. I kept asking that question, and I was lucky enough to have a client who is a psychiatrist, and she gave me a very long, detailed explanation why, especially the more successful people, deal in such mediocrity. And that's something that obviously we'll get into when we get deeper into the trading psychology. But just know that people will fight trends in spite of them being obvious. I've been blessed to be able to travel the world, speaking a good word on technical analysis, easy for me to say. And throughout my travels, I've met some incredibly smart people who fully understand markets, but end up fighting trends, or they'll get long a stock or an index or whatever the case may be. And then the index will drop 20% and they'll just let it keep dropping and go against them. And they won't sell out because they think it's too low to sell. And again, it's always dark before it gets more dark. Okay, we're going to take a quick break for a commercial and I will be right back. Let's talk about some simple ways to identify and stay with trends. Now, Technical analysis leads the way, but keep in mind that it doesn't have to be that technical, even though it has the word technical in it. The net price change is the most simplest of all indicators. In fact, I don't even know if you could really call it an indicator, but it could be quite telling. So you have to ask yourself, is the market higher? Is the market lower? Or is the market about the same as it was? So let's take a look at the current S&P 500. And if we draw a line going back in time, we see that from the current bar, and I like that Dave Keller named the show The Final Bar. And I was watching the show the other day, and he says, you always start with the final bar, and then you work your way backwards. So always look at the current price and work your way backwards. And we could see that the market really hasn't made a lot of progress in quite a while. And if you look shorter term, you can see we've dropped fairly hard in recent times. And if you add in today's data, which did not come in for some reason, but we'll get that fixed before next week, obviously, you can see that we've been in a little bit of a slide as of late. And if you go back a few weeks to the beginning of August or so, you can see that the market is actually down since then. Now, we have worked our way a little higher over the month or so. And then if you go all the way back to last December, the market has worked its way higher. But for the most part, you could see all these lines are kind of coming together in a bit of a sideways type of movement. So shorter term, I think the trend is turned down. And longer term, we're still in a bit of an uptrend, but that's beginning to become a little questionable in here. So for the most part, we're sort of sideways over the intermediate term. Now, if you look at a weekly chart, you can gain a little bit more perspective. You can see that it's a little bit cleaner in looking at the net price move. But for the most part, for the last several weeks, there really hasn't been a good trend. And that's the main thing you need to focus on, and then work your way higher. In fact, if you look at this chart, you can go back several months and you can see that we haven't made much forward progress. Now, one of the simplest things I discovered is what I call Landry Light. Years ago, I think it was in the mid-90s, I wrote an article for Stocks and Commodities called the 220 EMA breakout system. And one of the readers contacted me and he said he liked the concept of what he dubbed daylight. And then my wife got on me. She goes, when are you going to start naming stuff after you name like John Bollinger does? So we finally, with the help of a client, we came up with the name Landry Light. And that's simply the lows are greater than the moving average. And this is what it looks like on a chart. The low of the price bars are greater than the moving average. So there's light in between the price and the moving average. And the great thing about using something like Landry Light is that it takes some of the lag out, because all indicators have lag. In fact, I like to see indicators more as illustrators and not indicators, because they don't really indicate anything. They just tell you what's already happened in the chart. Now, on the downside, the highs are less than the moving average. And one thing that you'll be amazed with the next time you see somebody giving a presentation, I don't call them out on it, but if you see somebody giving a presentation with a signal, let's say they've got 100 buy and sell signals on the chart, usually they'll have a moving average plotted. Well, if you just would sell when you have downside Landry Light and buy when you have upside Landry Light, you'd probably catch just as good of trend as a more complex system. So if we're looking at the S&P 500 on a weekly basis, you could see we had a pretty good run, obviously, from 2017, 2018. We had some downside Landry Light late last year. And then for the most part, with the exception of just a little dip a few months back, we had upside Landry Light. Now, this is just the top histogram. It just counts the number of bars that the market has upside Landry Light, and on the downside, it counts the number of bars that has downside Landry Light. And this is something that I'm going to get into in a lot more detail when we get to market timing. But just know that if you have upside Landry Light, it's green. If you have downside Landry Light, it's red. And as you can see, it would have kept you long, or mostly long, for many, many years during the great bull run of the 90s. it would have kept you out of the market or short during the 2000 bear market. It would have gotten you back long on the trip back up and stayed almost entirely green the entire time. And then what's amazing, it stayed entirely red during the entire 2008 bear market. In fact, it actually went red in late 2007. So many people have said, man, that really caught me off guard. It's well, we had so many sell signals from a trend perspective. It was absolutely a wonderful time. We got stopped out of our longs, and then shorts started setting up late in 2007. I'm not saying this to be smug. I'm just trying to point out how something really simple can keep you on the right side of the market, and certainly give you a little warning when things are beginning to deteriorate. So if you can't wait till I get to market timing, I do have a free market timing course, and I'll give you the link to that at the end of the presentation. Now, a few years back, somebody emailed me and said, you mean to tell me that you could profit from trading by just drawing a bunch of lines on charts? And then he went on to say, please. So obviously, he was really skeptical. Well, I just grabbed a recent trade in here. And getting back to the ABC thing, well, this market, and this is an IPO, it had a pretty good run over a short period of time, and then it pulled back. And you can see on a net basis, it was very significant. It pulls back. And then this down here is my trading service. And on that particular day, I recommended the stock. And it triggered, and it ran up to hit the initial profit target. So that's a simple little A, B, C, looking to buy somewhere around C. And no indicators whatsoever were used on this particular trade, other than just looking at the chart. Now, I noticed Dave Keller does a mystery chart, and I'm not going to steal that from him, but I'm going to borrow it this week. And this is an actual setup for today. I actually have an order in to short this stock. I'm not a huge fan of the short side, but I will take what the market offers. And you can see that if we take a look at the chart and we look back in time, this chart has had a pretty serious slide. Then it pulled back a little bit. So we're looking to actually short this stock on this pullback. And I'll follow up on this one over the next few weeks. Now, if you're interested in any of the things I talked about today, and also if you're interested in my 3 books on trading, I'll actually give you all 3 of the books for free in PDF format, and then I'll give you access to the market timing course, which goes into the Landry Light in a little bit more deeper fashion, and also plays upon that ABC, showing you how to buy a market when it's above B and near C. Now, do we have any questions yet?
Yes, we do have a couple questions.
Okay.
Let's see here. You trade ETFs and inverse ETFs?
I do, with a few caveats. First of all, in order to do really well trading, if we go back to like that IPO chart, you're much better off trading something like an IPO where you have this big inefficiency. So this stock went up about, let's say, about 70% total. Now, I've since stopped out of it, but ideally, I'd like to get into some inefficient issue like an IPO or a small cap stock and ride it for a very, very long time. Take a swing trade profit off and then take a longer term, hopefully, profit by capturing longer term trend. An ETF is going to be much more efficient. Now, as far as ETFs, occasionally I will trade an ETF to gain exposure to a market, and then I will trade leveraged and inverse ETFs on what I call an opening gap reversal type of trade. So let's say you've got a nice trend and then the market gaps down. There's a pretty good chance that that shakeout might have knocked out some players and that market might immediately reverse and go back up. This is not my bread and butter, but it's a way to sometimes pick up a little money. Kind of reminds me of the Jimmy Rogers. I just wait until his money lie in the corner and then I just walk over there and pick it up type of trade. Not always, but if you can wait and be very patient to take the best of the best setups. Now, I would not hold the inverse ETFs overnight, and I wouldn't hold the leverage one either due to the tracking error. But the inverse ETFs, if you read the prospectus, I know having trouble sleeping at night reading prospectus, right? But they're just trying to track the 1 day change, and that really gets kind of mucked up over time. In fact, one thing I've noticed is all inverse ETFs eventually go to zero. So holding them longer term is a bad idea. But for an intraday trade where you look to play that opening gap reversal and to hold on for as much as that intraday trend as possible, that could actually work out pretty nice.
Okay, we have about 4 minutes left in the show, so I think we have time for 2 more questions from the room. The first is, what time frame is your go-to chart for trend determination, and what is the average length of time you hold a position?
Okay, I like to use daily charts when I'm swing to intermediate term trading. And as far as a look back, it all depends on the chart itself. So you can take a look at this IPO that we still have up on the screen. So this trend set out within about 2 weeks. Now, if it's an established issue, I like to see a little bit longer term trend. But if the magnitude of the move is pretty big, like we had on this IPO here, which is about, I think, 40 or 50% just eyeballing it over a couple of weeks, that's plenty enough time. Now, as far as my holding period, people always say, what's your holding period? And my answer is 10 years, hopefully much longer. Now, obviously, being a swing to intermediate term trader using fairly tight stops, I'm going to get stopped out a lot sooner than that. But I have been fortunate enough in some cases to hold stocks for as long as several years. So you can't predict the long term. This is something that we're going to get into when we get into the money management. You can't predict the long term when it comes to markets, but in a case like this, you know that this market has the potential to make a little bit of a pop higher, and that's where you can get the swing trade out. So we're looking for that short-term gain using fairly tight stops, and then if it works out, we'll take that partial profit, we'll have our stop move to break even, and then we'll allow that stop to gradually widen out, sort of like I showed in that cocktail napkin earlier. And that's where the real money is in those longer term trends. So as far as average holding period, I probably get knocked out within a few weeks, but ideally I'd like to stay with the position for a few years.
Hey, Dave.
Yeah.
We just have a little over a minute to go. So just to wrap things up, what are your final thoughts on the market?
Right now, I think the market's in a little bit of trouble. We've been in a little slide as of late, obviously. My database has been speaking. I am mostly short right now. Again, I'd rather be on the long side, but you have to take what the market offers. I think shorting is important because it helps you to see both sides of the market, not because you're going to get rich on the short side, but I do think it's important to learn how to short so you can see both sides of the market. My friends who run a lot of money, they always kind of see the market as glass half full and not glass half empty. So right now I'm a little concerned about the market. The database is not producing a lot of setups, so I'm going to sit on my shorts for a little while now, see what happens. I'm long a couple gold stocks, and I think you might just want to sit tight for now. And until we see new highs in the overall market, I wouldn't rush out and buy a lot of stocks right now.
Thanks, Dave. And so congratulations on a great inaugural show, and we are looking forward to having many, many more with you in the future.
So am I. Thank you so much, Rachel.
Yep.